Fortunately, we didn't get the hot inflationary print that I think investors were fearing yesterday, which gave front-end rates and equity markets a brief reprieve. But this morning, I think investors are once again focusing on the conflict in the Middle East,
right.
And sensitivity to energy prices. So, as we've been seeing, these reprieves in the market are short lasting, and then there's a renewed focus on the geopolitical events that continue to dominate.
I featured Liz Goldenberg this week on my tweet thing I do after Bloomberg Money, and she's always beating on me. Price matters. Are we at a point yet where the street is moving from a yield analysis to OMG? Look where price is. Are we there yet?
Yeah, look, the yields are attractive, and I think that's one of the reasons why we now see close to $8 trillion in money market funds. So there's been a massive growth in AUM in that sector. So the yields there are definitely taking cash off the sidelines, and that's soaking up some of the bill supply that we continue to see. But when you have the size of moves that we're seeing in equity markets on a daily basis, that's still the preferred asset class for the investor class that we talk to.
Darren, we heard from Fed Chairman Warsh in front of the House committee yesterday. We'll hear him speak in front of the Senate today. Any takeaways there? I mean, he says, I guess the headline from the Bloomberg terminal was, inflation is at intolerable levels here, So it seems pretty focused.
Yeah, we heard a lot of talk about price stability, which I think if you're a new Fed chairman and you're trying to reinforce Fed credibility, that's definitely the line that you're going to take. So given the balance of risks to the mandate right now, it's no surprise to us that the Fed and the balance of the committee are very focused on the inflation side of the mandate.
But there's not a whole lot that the Federal Reserve can do about the price of oil. The guys in the oil pits and wherever they're trading this stuff, it's going higher here.
Yeah, look, that's the macro risk, that's the geopolitical risk, and I think that's why rate markets, especially the front end of these curves, are resensitizing to what we're seeing in energy markets. You can have a reprieve like yesterday with a softer CPI print, but big picture, you can't lose sight of the geopolitical backdrop.
I mean, Paul, I think it's very important to go to the Bloomberg Professional Service.
Yep.
And look at BTMM, our fabulous money market screen. That alone is worth getting a Bloomberg terminal in your second home. And I'm looking at when the Red Sox began their 9-game winning streak. And the price on a 30-year bond, are you ready? Down 4.6%. In price, just since they began their 9-game win streak. It's an extraordinary convergence.
10-year Treasury yields, 4.6%. How about that? And the 30-year, 5.12%. Are we in a higher for longer level, do you think, here?
It feels like for the time being that might be the case, but we're going to have to start monitoring the correlation between the Red Sox and long-end yields in the Treasury curve. I don't think that's on my Bloomberg page, but that's going to be a takeaway today.
We haven't done that since Dick Raddatz, and you don't know who that is. To continue. Help me here with the hyperscalers. I look at Amazon, I think it's 50-year piece, whatever, and Torsten Slack out today saying it used to be 5 times subscribed. Nomura on the desk, when there are these big bond hyperscaler things, are fewer people calling in?
It feels like the market's starting to become saturated with some of the IG tech name paper that we've seen this year. We've had a massive amount of investment grade paper, especially from the tech sector. And to your point, we've started to see some of these deals become less subscribed to than they were earlier in the year, where they were massively oversubscribed. But still, it's attracting yield buyers. These aren't buyers necessarily on spread yet. But you do have to start to wonder, given the equity story, given the amount of debt issuance from these names, are we getting closer to a point where this paper is becoming saturated in the market?